Well, time now for a look at the day's business news, for which we are joined by Stephen Carroll. Hi, Stephen.
Hello.
Okay, so we're going to start in China and another twist in their pretty tense trade relationship with Europe.
That's right. Earlier in the week, we had these reports. They've now been confirmed. China is launching an anti-dumping investigation, another one against European and US companies. This time, they're focusing on the chemical industry, and particularly one chemical which is used in dry cleaning. Now, China's Commerce Ministry says that these chemicals are being sold at a below-cost level on the Chinese market. This procedure known as dumping. It's the second investigation of its kind launched by China against US and European companies this month, and it comes as the EU is proposing to impose heavy import duties on Chinese solar panels. Now, earlier we spoke to our correspondent in Beijing, Shannon Van Sant.
This back and forth between China and the EU right now over chemical imports, but over other industries over the last several months as well, has really sparked fear of a trade war, both amongst European businessmen and also amongst people here in China. Chinese Premier Li Keqiang warned that the EU and China were potentially headed for a trade war. The EU is also investigating solar panel companies in China for dumping in the EU, as well as Chinese telecommunication firms Huawei and ZTE. So this sort of back and forth in terms of potentially toughening up some of these trade restrictions in ways that could really harm the profits of these companies and these companies' desire to expand. European companies' desire to expand in China and Chinese companies' ambitions to expand in Europe have sparked this fear of a trade war. Now, for the EU is China's most important trading partner, and for the EU, China is only second to the US in terms of trade. So this has a lot of impact both on the domestic economies in the EU and China, but also to the global economy.
Okay, we turn next to Japan, and the International Monetary Fund is warning against the risk of increasing its national debt.
Yeah, perhaps another worry for supporters of so-called Abenomics. This is the economic policies of the Japanese Prime Minister Shinzo Abe. Now, along with the Bank of Japan, his government has been embarking on this massive fiscal and monetary stimulus to try to kickstart the world's third largest economy after years of stagnation. Now, they're targeting an inflation rate of 2%, hopefully by the end of next year. But new figures out today in Japan show that consumer prices actually fell in April by 0.4%, the sixth consecutive month of falls. Now, the IMF says the government's plan is on the right track, but has warned that Japan's huge debt, twice the size of its economy, could hinder their efforts. Now, Shinzo Abe's policy have had an effect on the markets as well. The Nikkei has risen by 30% since the start of this year. But these doubts being introduced and now being echoed by the IMF have seen a recent fall in share prices. Last Thursday was when the fall began and continued right through into yesterday's trading, down 5.2% yesterday. Better picture today, up 1.37%, the Nikkei in Japan. Turning to Europe now, where trading has just opened. A negative start to the day in Europe. Markets all in the red there. A couple of figures that could hit trading, though. Household consumption, we learned, fell in France by 0.3% in April after growth in March. Similar for industrial production prices, and retail sales in Germany down too. So a couple of worrying figures out of the Eurozone that may impact the markets later.
Well, some more worrying figures are the latest numbers on unemployment here in France.
That's right, record-breaking. 3.26 million people in France now out of work, the highest since records began. This is 2 years of losses we've seen running up to this, 2 years of increased job losses rather we've seen running up to this. The number of people out of work has been on the rise for some time, 40,000 more in April than there were in March. Now, the rate of unemployment stands at 10.2% at the end of 2012, but the OECD and others have said that this will increase to as high as 11.5% by the end of next year.
Well, Hollande's saying that tackling unemployment is a priority, and he came up with some ideas when he met with German Chancellor Angela Merkel on Thursday.
That's right. The philosophy behind their meeting to create growth will also help the jobs situation. Now, they gave us some idea of their plan they'll be presenting to their European colleagues at the end of June. The overall principle is to create growth while bringing down the budget deficits at the same time. Easier said than done. They gave us some idea of their plans. They want more coordination of economic policy between Eurozone countries, more meetings of the Eurozone and a full-time president, and a European infrastructure investment plan, one key area they feel can help to create growth. Also looking at European industries and hoping for some renewal there. Now, they'll be looking for Europe-wide support for this plan when they meet with their European counterparts at the end of June. And the real question will be is where the money will come from to do this.
Okay, now one measure the French government has put in place to try and create jobs was a tax credit for employers. But many businesses are finding that they're not getting the benefit of the reduction. Catherine Viette has the story.
This logistics company is one of 1,500 French businesses that's benefited from a tax credit for job competitiveness, a fiscal stimulus put in place by the French president with the goal of creating new jobs and helping employers better weather the economic crisis.
There are 800 employees that are eligible for the tax credit program. That's a 4% reduction, which roughly works out to an estimated savings of between 500,000 and 1 million euros.
But even before Thomas Mortier could benefit, the tax credit whetted the appetite of some of his clients. 2 months ago, one multinational sent him an email claiming a share of the pie.
The sentence is clear. The tax credit is an amount equivalent to 4% of gross wages, up to 2.5 times the minimum wage. So we want a 2% reduction in our 2012 prices.
Mortier refused, but this was not an isolated case. In this polling and consulting company, the same scenario and a similar email. But this boss preferred to give in, afraid he would lose his biggest client.
It's nothing more than theft, a measure that was intended to help businesses hire and recruit, though now it's being abused by companies who are our clients, and we now have no choice but to comply.
Mediators handling disputes say what these large companies are demanding is wrong.
It's both immoral and illegal. It's immoral because obviously when the state makes 20 billion euros available to companies for employment, for competitiveness, for investment, it's immoral that some businesses want an immediate piece of it in the form of lower prices. It's also illegal because it's an abuse of power and that's punishable.
The French Minister of Industrial Renewal has denounced the practice, warning he would call big companies who are pressuring their suppliers.
Now, just enough time to look at a police raid that's highlighted the shortage of some pretty essential consumer goods in Venezuela.
That's right. Now, shortages of consumer goods are nothing new in Venezuela. People are well used to them, mainly due to the falling value of their currency, making it more difficult to import products. But Venezuela's Interior Ministry has announced that a police raid on a warehouse in Caracas has uncovered 2,450 bales of toilet paper, 7,000 litres of fruit juice and 400 packages of nappies. Now, toilet rolls is one of the most sought-after consumer goods in great shortage in Venezuela. The government had to announce last month they were going to import 50 million rolls to combat the shortage.
Right, well, brilliant. Thank you very much, Stephen Carroll there with our business roundup. Okay, that's it from us for the moment, but stay with us, a short break, and we'll be back with more.